What we'd like to accomplish today is I want to show you the two different ways that you can take the weekly trades from Steve Scanner. Today is a unique day because we don't get caught report data until this afternoon, and so we have not taken our weekly trades yet from the scanner. And so I thought today would be a great day to go over how to take the trades, what it's like to process your risk management in your trading account, to make sure that you're taking these trades correctly, approximating how much time it would take to take these trades in your account, and then just helping you along through the process of what it's like to hold a trade throughout the week, what it's like to lose on a loser, and then obviously what it's like to close the trade on Friday when it's time to close the weekly trade. So I'm really excited to go through this. This webinar is not really to explain why we take these trades. That's what the COT report webinars are for. This one is just to show you the accurate application and demo on how to take it. So we'll actually go into a trading account. We'll take some trades together and show you what it's like to go through that process. Okay. Before we get started, as always, I need to remind everyone about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your lot size is and ultimately how that would affect your account if you were to lose money. So make sure that you're going through that process each and every time that you take a trade. All right, guys, let's go ahead and jump to this. Like I said, just want to welcome everybody here. I also want to give a shout out. And like I said, just want to say hello to those of you watching this through YouTube or through the recording on the website. Okay, cool. So let's go ahead and jump into how to do this. So let's go over the two different places where you can find the weekly trades from the scanner and when this updates. So if you go to the website, if you go to tradingwithsteve.com, right on the homepage of Trading with Steve, you can find Steve Scanner right up here at the very top in the ribbon up here. If you click on Steve Scanner, it's going to pull it up. It takes just a second to load, but once it loads up, you can see the overall signals for the week. There's a lot of different columns on here and it can get kind of confusing. And all of these things are different data points and different ways of looking at the markets. You really don't need to worry about the rest of the things on the scanner if you're just taking the weekly trades. If you want to do further deep analysis into a particular currency pair, you are certainly welcome to do that. But if you're just looking to take the weekly trades, all you have to do is just filter the overall signal column, which is just this second column right here. If you just filter this, click it 2 times, it's going to pull up the overall strong buy and strong sell signals for the week. Steve Scanner classifies a trade or currency pair into 5 different designations. You have a strong buy, strong sell, sell, buy, and neutral. Neutral basically means there's no signal. Buy would be, we're leaning towards the buy direction. Sell would be, we're leaning towards the sell direction. Strong buy is meaning we're taking this trade. This is a trade that we're going to take. If it says strong sell, we're definitely going to take this trade. So I only worry about the currency pairs that say strong buy and strong sell. You're typically going to have somewhere between 5 and 10 strong buys and strong sells week over week when you're taking these trades. So if you look at right here in the overall signal column, we've got 1, 2, 3, 4, 5, 6 different trade alerts this week. So that's pretty typical. And by the way, these are not the signals that we're planning on taking this week, because again, we're waiting for the COT report data to update this afternoon. So sometime this afternoon, you'll see this update. And then in the evening, you'll take your weekly trades for those of you that plan to take these. But these are the ones from last week. And obviously we had a great week last week. It was fantastic. And these were the trades that we took. And we had 6 of them. Like I said, you're going to have anywhere between 5 and 10 typically that you're going to be taking. Okay. So you really don't need to worry about the rest of the stuff on the scanner. If you're kind of a nerdy person and you would like to learn about the rest of the things that the scanner does and looks at, I'm happy to teach you those things in the other calls. We've also got some other resources for you down here. This particular video is pretty good. It goes over the different types of metrics on the scanner. It goes over like what the 3-week shift is, the 5-week shift, the long-term signal divergence, a crowded market, the sentiment signals. All this stuff contributes to the overall signal for the week. But you don't need to worry about this stuff when you're just taking weekly trades. Again, it's just very important to just focus on only what you need to focus on, which is this right here. The overall signal takes into account all the other metrics that the scanner looks at. So when it looks at sentiment, when it looks at the long-term signal, the crowded market stuff, the divergence stuff, the 5-week shift, the 3-week shift, all of that stuff contributes to the overall signal. So rest assured that you're taking the best trade of the week when you're just or at least you're following the best trade that the Steve scanner knows how to figure out when you're just taking the overall signal. So you really don't need to worry about all the other things in there. Okay. Cool. So this is all. So this is one place where you can go to get these. Another good place to go is if just right here in the Telegram channel. So this is the second place you can go to get the weekly trades from the scanner. On the weekends, I'm going to post what looks like this. I'm going to show you the posts that I post. Every Sunday, I post this. Sometimes it'll be on Saturdays, but it's typically Sundays. It looks just like this right here. This is the last one I posted. I'm going to post almost an identical post like this evening, and you can expect this. So if you're somebody that works really well with routine and expectations and stuff like that, you're always going to get this post. It's going to come every weekend. All right. So if that's something that you want to incorporate in your routine, fantastic, because this will be there. What's included in this post is a picture. And it's a picture, and I've circled or not, I've squared up the top signals of the week. So it's pretty obvious which direction we're going. It's like, hey, here's the Aussie Kiwi, we're selling it. Here's the Euro CAD, we're selling. We're buying the CAD yen and buying the franc yen. All that stuff's very, very clear over there in this particular picture. Right. And there's some other information. There's links to the lot size calculator. I'm telling you about how I'm going to manage risk. There's some videos here, like this video's and a little bit of an older video, like from 6 months ago, on how to take the weekly trades. It's still valid though. And then there's the second video right here, which is more recent. And this is the stacking method, which I'm going to teach you how to do both of these today in this webinar. So this is right here. So if you're ever in doubt, like what to do, there's resources for you right in this post every weekend that will tell you exactly how to take these trades. All right. So that's the second place where you can get the signals. All right. Another thing to remember is that Steve's scanner is highly dependent. In fact, 6 of the 7 different variables we monitor with Steve's scanner is based off of COT data. For those that don't know, COT report data stands for Commitment of Traders Report, and it comes from the CFTC. It's a financial regulatory authority here in the United States, and they give us this COT report every Friday, and it's a summary of what the banks have been buying and selling. And so our scanner is really smart. It goes out and looks at the data from 6 different angles, and it ultimately delivers those metrics to you on the scanner. But most importantly, it's smart enough to deliver the most high quality weekly signals right here in the overall signal column. Okay. One other thing that you'll notice before I move on to actually how to take these trades is a lot of these signals are highly correlated. That's on purpose. The scanner is often going to get similar data on like the euro. So like if you're trading the euro yen or like the euro CAD, the euro franc, a lot of those currency pairs will have the same general signal because you're trading a currency that's got a relationship to a lot of other currency pairs. It's the same thing like if let's say I was buying in the stock market, if I were to buy Apple, Apple is a very similar stock to Microsoft. So if the industry looks really good for Microsoft as it looks for Apple, both of those stocks would likely go up at the same time. So you're not necessarily super diversified just because you're buying Apple or just because you're buying Microsoft and you've got both of them. That might be, you might have some diversification from a company to company basis, but you're still in the same direction. You're still buying that market in the same direction because that's the industry. Those two players run the industry, right? It's the same thing in Forex. If you buy the euro with one pair and buy the euro through another pair, it's often the same. So as a result, one of the things that you'll see that happens with the scanner is most of these trades will be highly correlated. And as a result, When you have winning weeks, most of the winning weeks, you'll have just straight winners. It'll be pretty much a flat, like, okay, we won almost every single trade that we took. And then on losing weeks, it can be almost the exact opposite. It's not always that way. Like we had a losing week like 3 or 4 weeks ago where um, we actually did have a couple of trades that lost and a couple of trades that won. That's a little bit rare. I feel like when it loses, it's probably going to lose most of the basket of trades, and then when it wins, it's pretty much going to be a straight winner type of thing. So let me answer this question here. Carrie says, do the 3 week and 5 week tabs refer to past or future timeframes? Great question. Yeah, so they are past. These are backwards looking because they look at the COT report over the last 3 and 5 weeks. So the 3 week shift is a percentage right here. So if you look at this number right here, this number is the 3 week non-commercial percent net shift. What that basically means is over the last 3 weeks, as a percentage, how much have U.S. banks increased their positions on that currency pair or decreased? So, for example, on this Aussie Kiwi, the U.S. banks have decreased their positions by the tune of 84.62%. So the banks are definitely trying to sell the Aussie Kiwi over the last 3 weeks. The 5 week shift is similar, a little bit more negative, and so that means over the last 5 weeks, the banks have decreased their positions. The reason why those two numbers are important, and again, as I know not everybody showed up right when the webinar started, but this webinar is not to explain the COT data in detail. It's more so to show you how to take the trades. So I'll just answer this quickly, but I just want to let everybody know if you need more information on how COT data works with the scanner, we do a weekly webinar on Thursday nights. It's the COT report webinar where we answer very specific and pointed questions about how COT data works and specifically how it works with the scanner. So if you want more information on that, come to some of those live calls. This week we had to cancel it because I'm busy on Thursday. But our next one will be a week from Thursday, and we'll answer those questions. But yeah, real quick, the reason why this is important is because these banks typically work on a 3 to 5 week scale. So when they're buying something over the last 3 and 5 weeks, that's usually a pretty telltale sign that their game plan is to send the market that direction. So when they build out a new signal for themselves, whatever they're buying aggressively over the last 3 and 5 weeks is usually a pretty good indication that the market's going to go that way in the coming weeks and months. So yeah, that's a great question. Okay, cool. So this is where you get the information right here. This is where you get the signal. And then the other important thing that you're going to need off the scanner is the ADR, which is over here. Okay, the ADR is not a metric that is gathered from COT data or anything like that. The ADR is the average daily range. The reason why this is important is because this is how we base our stop losses with the scanner. So what we typically do when we're trading the normal vanilla method of taking the weekly trades is we're just going to take the weekly trades from the scanner using a 2x average daily range. So for example, if I were to sell this Aussie Kiwi and I was going to hold the trade all week long, I would need a stop loss of 88 pips because that's 2 times the average daily range. And then I would just plug in that trade and let it sit all week. Let's do that together. Let's do a quick demo. So let's say I'm you guys and I've got the trades either here or I've got the trades right here on Telegram, and I'm about to take these on Sunday night, which, by the way, that's when you're supposed to take these trades, is either Sunday night when Tokyo opens, and any time between then and like Monday morning is good. If you wait to take these trades until late Monday, or if you wait until Tuesday or something because you forgot, that's not a really good routine that you should get yourself in. You really want to have a routine of getting these in early in the week. There's going to be a lot of weeks where you miss out on a lot of pips if you don't get these in early on Sunday. Like if you wait until Monday when London opens, you could miss out on a lot of trading opportunities. So I highly suggest that you get these trades in early and get that routine built in. Plus, what's nice is you can get these trades into your account And then if you're a busy person, you work another job, you've got kids, you've got people you take care of, whatever it is in your life that occupies your time, this is something that doesn't have to occupy a ton of time. You can put these trades in your account and then you can leave them till Friday and then close them then, right? Okay, so let's take this trade together. So let's pretend that this is the brand new. Again, we're still waiting on the signals to update until tonight, but let's say that these are the trades we're going to take. Let's take this Aussie Kiwi trade. It says strong sell. So I'm going to pull up my TradingView account over here, tradingview.com. This is where I typically take trades. Let's open up a demo account. I've got a free demo account with TradingView that I'm going to use just to take a practice trade together with you guys. So I've got this account logged into now. So I'm in here and you can see my demo and I can go ahead and start taking trades in this account. So let's pull up the Aussie Kiwi. I have a watch list over here with all the Forex pairs. I've actually shared this watch list before. If you want my watch list, I can send it to you so you can use it and adopt it yourself. It has all 28 major Forex pairs, and it includes all the CFDs that we trade like gold, silver, NAS 100, US 30, and oil. All right. If you can't find the currency pair in your watch list, all you have to do is just go over here to the top right in TradingView on a super chart and type in what you're looking for. So in this case, we're going to trade the Aussie NZD, which is AUD NZD. And then I'm going to click on this. And it doesn't really matter since I'm using Forex's, or I'm using TradingView's free account here. It doesn't really matter which one I click on. So I'm just going to click there. All right. So here is the Aussie Kiwi. All right. And what's the signal again? So if I go back and click on the scanner right here, it says strong sell. So let's actually go ahead and do that real quick. I'm going to show you the fastest way and the easiest way to do it. In fact, you can even bypass the lot size calculator on the website. There's a faster way to do this. Let me teach you how to do this really quick. So,
hey traders, it's Steve from the future. I hope you have enjoyed this video so far. If you are getting value out of this video, be sure to hit the like button, click the subscribe button, and share your trading thoughts. I read all the comments, so feel free to ask any questions you have there too. On a side note, I host live trading calls like this one you are watching every day. Some of my biggest trading secrets I share exclusively to just the members in my program. I host these live trading calls every day, Monday through Friday at 11 a.m. Eastern. I also host a basic training webinar every Monday for the newer traders and the regular COT report and sentiment trading webinars every Wednesday night at 8 and 9 p.m. Eastern for the advanced and aspiring traders. All of these calls are recorded and promptly posted on the members' trading calendars at the conclusion of each call in case your schedule does not permit you to come to the live call. All of my members have complete access to the scanner. We call it Steve Scanner. This is an instant.
So let's actually just go ahead and click the sell button because we're going to sell. Now, these scanner signals, the vanilla way to take these trades is just to do a market order. I'm going to show you the second way to do this, the stacking method at the end of the call, but I'm going to show you the vanilla way first, and it's going to be super easy. So you just click the sell button, and now you have to design up your trade. We always use market orders when we're taking these trades. We don't use limits. We don't use stops unless you're using the stacking method, then you'll use stops. But market order is the way to go. If you want to just bypass the lot size calculator, you have to skip units for now and come back later, which I don't know if this is a good way to do it, but I'll just show you. Maybe I'll show you both ways. We don't use a take profit. So it's super nice because you don't have to put anything in here. You can just literally leave the take profit alone and you can go right to the stop loss. Okay. This is the most important part. I think this and the risk that you're going to be employing is very important. So you can put in the stop loss as represented by pips. You can do it by price. You can do it by dollar amount, or you can do it by a percentage of your account. The easiest method, guys, is just to put in the number of pips. That's why it's the number one. That's the first option. So you don't need to worry about the price. You don't need to worry about the dollar amount. You do, but it's not something you have to put in, right? So as far as pips go, what am I going to do? Well, I just use a 2x average daily range. So if I've got 44 pips here, as my average daily range for the Australian Kiwi dollar, then 2 times that is 88. And you can, if you don't know how to add, if math's not your thing, just pull out a calculator and just, all you do is you would just say, okay, there's 2 ways you could do it. You could just take out a calculator. Here, let me grab it real quick. You could either multiply, the average daily range by 2, or you could just add to it. So you could take 44 times by 2 and there's 88, or you could just take 44 and then plus 44, and then there you go. So really simple. If you're good at math and it's an easy arithmetic thing to do in your head, perfect. But if you're not that type of person, that's totally okay. And you can just pull out your calculator. It doesn't matter how you do this, just whatever makes you feel comfortable, right? So we'll do 88 pips because that's what the average daily range is. Okay. Or it's 2x average daily range. Okay. Now we're not ready to take the trade yet because I skipped this part, the units. So now that my pips are in, now I can actually come back up here and I can change my risk. I usually do a percentage. Okay. So if I'm going to do a percentage, the easiest thing to do here, and actually let me pause for a second. This is the amount of money of your account that you're going to risk. So if I put in 0.25, that means I'm risking 1/4 of my account at 0.25. Okay. If I were to put in just 1.0, that's 1% risk. Okay. That means if I lose on this trade, I'm going to lose 1% of my entire account. And if that's okay to you, then you're good to go. If that's not an okay risk, then you need to lower that. Here's the general recommendation that I've been posting to people. This is very conservative, but it'll keep your account generally safe. I typically have been, and we've been doing this for years now, I feel like 1.5% risk divided by the number of signals. What this does is some weeks you're going to get like 10 signals, and we don't want to double up the risk because we've got more signals. So we have to kind of balance this out by having a fixed amount of risk each week that you risk, and then you divide it by the number of trade alerts you get. Some weeks you might only get like 5 or 6 signals, which is kind of a lower amount. And if that's all we get off the scanner, then you may want to risk a little bit more money per trade, so it equates to a total of 1.5%. So what we've been doing is just taking 1.5% and dividing by the number of signals. This last week we had 6 trades. So if you take 1.5 divided by 6, it equates to 0.25%. So that's what you'd put in as your risk is 0.25. And I'll tell you what it is. If you just want me to tell you what you're supposed to risk, you can just follow exactly what I've said right there. I will say that this is conservative, so this will keep your account generally pretty safe. You're not going to fail a prop firm challenge, at least very easily. It'd take a long time to fail a prop firm challenge, and probably maybe you wouldn't fail a prop firm challenge. I can't say I guarantee that. I just can't say those words, but you're let me just put it this way: you're safe if you do 0. If you keep it at the risk I give you here. So over time, you may want to have one-on-one calls with me where I help you ramp that up and kind of know what a good risk for you is. But if you just want to keep it steady and follow the traditional way of doing it, just do what I tell you to do right here, which is 0.25%, right? Okay, so I got 0.25% in. That equates to $281 of my account. So if I lost, I would lose $281, and that's something that we're okay with. And then you'd be good to go. So let's this trade's ready. Like you don't need to do anything else. The units have updated because we've put in the percent risk in here. We've got the stop loss for the week, and boom, you hit the sell button, and now you're in a sell on the Aussie Kiwi. You can see when I scroll this down, my stop loss is up here. That's 2 times the average daily range. You can see that if I lost it, I would lose $281. That's another way you can double check, by the way, to make sure your work is correct. If that's in a suitable amount of money that you're okay losing, if the trade were to go the wrong way, then in good shape. Now, what we hope is that by the end of the week, the market just continues to slide off. We want it to come down and go as far as it wants to go. And because we aren't using a take profit, if this trade wants to go 2, 3, 4, 500 pips in our favor, let it do it. Let's let it do that. Right. You'll learn this over time, but one of the things that I think makes our strategy so valuable is the fact that we're holding on to winners for so long. Okay. A lot of other groups will take profits. And when we take profits too, but well, they'll just be like, I made 100 pips. I'm good. We can't have that attitude. This strategy is going to teach you how to hold on to winners. So you're going to have to get a little comfortable with just letting winners run in your account during the week, which is easier said than done because we all know how it is, right? Sometimes you get a winning trade that gets up 100 pips and you're like, man, I want to take that profit. But we got to let the trades run because you can have trades that go 2, 3, 4, 500 pips. I think the best trade I've ever taken, I had a trade last year on the euro yen that made almost 800 pips in 1 week. That was my best ever weekly trade. It is an EJ trade, so it makes sense because the yen pairs have huge ADRs. Made almost 800 pips. But it's pretty common to have trades that make 500 pips. I think last week we had a trade on the franc yen or CAD yen, I can't remember, that ended up making like 200 or 300 pips. We had a pound franc trade that ended up making over 100 pips. Which if that same signal were on like the pound Aussie or pound yen, because the ADR is so big, you probably would have made many hundreds of pips on those trades. So yeah, you do have to kind of get comfortable with that. The other thing too is you're working with bigger numbers here. Like this trade could easily lose too. Let's say that this is a bad signal and the market goes to the stop loss. We got to let those trades lose. If you ever have a trade that hits the stop loss, which you will if you keep trading this, we don't get every trade correctly. And even some trades go the wrong way against us. They hit their stop losses and then they, of course, go back in our favor, a few days later. That's just the normal course of trading. We have to let those lose. And when they lose, let them lose. Don't worry about, don't worry about it, basically. Don't worry about getting back in. If your trade closes out, you'll come back next week and we'll get better trades for you. So you got to kind of subscribe to that routine. Let's see. Alejandra says, are the weekly trades all need to be closed on Friday? Yeah. So they should be. I will say this. It's funny. I had a couple of different trading accounts where I took the trades last week. I thought I had closed out everything on Friday. I'm human too, so I make these mistakes. Like, yeah, go figure. I still make these mistakes. So if you ever feel like, oh, dummy me, I forgot to close the trades on Friday, I literally did that on one of my accounts. I remembered on Saturday, I was like, oh, wait, did I close my trade? I'm like, no, I didn't. So no, I was actually one of my live accounts too, like with my own personal capital. It wasn't like a demo. It wasn't like some small prop firm account. Like it was my big live trading account. I forgot to close out those trades on Friday. So it was easy. Like I left them on over the weekend. They actually improved a little bit over the weekend. And I ended up closing them during the Tokyo session yesterday. And actually in hindsight, I kind of wish I had kept them because it looks like they would have still kept going in our direction. Up until today. But yeah, that's the strategy rules, is to hold them all week and then refresh the next week because you're going to get new signals with the scanner. And so whatever those new signals are, you're going to take those. A lot of the times you'll also notice that sometimes you'll have duplicate trades from the previous week. Like for example, let's say, we sold the pound franc last week. Let's say we have that same signal again this week. That can happen a lot. So you might close that trade on Friday only to reopen the trade Sunday night. That's pretty common stuff as well. And don't be surprised when you see that happen. It's very common to have duplicate signals that continue week after week. So Great questions, guys. Let me do one more example on how to take the vanilla trades, and then I'm going to teach you guys how to stack the stacking method. Okay. So that's one of the 6 trades, right? I'd have to do this for all 6 orders, right? So the next one is this Euro CAD. Actually, let's do a buy because I want to do a option. So let's do this CAD yen because it's a strong buy right here. Okay. CAD yen, strong buy. So let's pull that one up since we know that that's one of the trades that we're going to be taking or that we did take last week. And again, I'm just pretending I'm you guys. I'm pretending that I'm, I guess, us taking these trades at the beginning of the week, right? Okay, so I'm going to hit the buy button. Okay, really easy way to do this. Just click the buy. We always use a market order. Right here is where you would go to the lot size calculator on the website. But if you wanted to make it even faster, again, this is another way you can do that. So you'd have to go to the lot size calculator on the website right now and figure out what your units are going to be. Or you can just do what I'm doing right here. So you can skip the take profit because we don't use a take profit. That makes it easy. Go right to the stop loss, turn the stop loss on, delete the pips here, and we got to figure out how many pips we're risking. That's super easy because all you have to do is just pull up the original signal on Telegram. And all you're going to do is you're going to find the ADR, which is right there. So for the CAD yen, it's 76 pips. And I use a 2x average daily range when I'm trading the weekly trades with the vanilla strategy. So the vanilla way is 2x ADR. So if I have 76 as my average daily range on the CAD yen, I'm going to multiply that by 2. And that's 152 pips. Okay. So that's my week long stop loss that I'm providing. That's the space I'm providing the CAD yen this week is 152 pips. Okay. Now I'm not quite done yet because I need to because I skipped the lot size calculator. I'm basically going to do that last now. And I'm going to change my risk to, whatever I'm risking this week, which let's say is 0.25. And I'm going to provide this percentage to you right here in the actual Telegram post. So you can just copy whatever I put there and put it in right there. You can't do this first, by the way. Let me actually give you an example of this. Like, let's say you were to change this first, 0.25. The problem with doing that first is now you're going to mess up your stop loss because it has this defaulted at like 10 pips. And now I have a 10 pip stop loss instead of 152, which I guess it actually holds it. No, it's still pretty good. Never mind. I think you can actually do that. You just have to remember to put in your stop loss and change this up. Otherwise, it messes everything up. So there you go. So it's got the units all figured out for you, 27,000 units, risking 0.25% of my account. I've got 152 pip stop loss, which equates to $281, which is exactly 0.25% of my account. Now I'll just go ahead and click buy, and boom, that trade is now ready to go for the entire week. You don't have to do anything now. Like, you can let this trade play out. It can go to the moon, and you can make a lot of money by Friday and close it out for whatever it's worth on Friday. If the trade loses, it will lose automatically. You don't need to do anything as far as analyzing the charts. You don't need to go in there and be like, should I close this? Should I not close this? Nothing subjective at all. This is a very objective approach to the market. What's nice about that is it will avoid your own, you can't sabotage this is what I'm trying to say. It's easy for us to do that as a retail trader, is to sabotage our trades. Since this is an objective approach, you avoid all of that. It's just very much set it and forget it, exactly like Muhammad says. Can you use a trailing stop? Yeah, you can use a trailing stop. If you would like to on this vanilla strategy, I think it's actually not a bad idea. So I actually don't know how to set up a trailing stop on TradingView. I hear you can. I haven't been able to figure it out. So I'm not going to show you because I don't know how. I know exactly how to do it in MT4. And I could teach you guys how to do it on MT4, MT5. But yeah, so Carrie says, do you advocate pulling up your stop losses? Yeah, with most strategies, I do. And even this one, it's a good idea as the trade starts to move in your favor. Um, but it's not required to be successful though. So if you want to make it, just set it and forget it. You really could literally just leave it alone until Friday. Usually, I've seen people who do just leave these trades alone generally do better. Um, and it's okay. Like if you approach me, I'm not going to be mad at you if you text me on Tuesday or a Wednesday and you're like, "Hey, Steve, we're having a great week. Should we take profits?" Sometimes we'll actually take some profits off the table, especially if there's a big news event coming up like FOMC on a Wednesday, or if we have NFP on a Friday, we might take some profits off the table. That's okay. But generally speaking, if it's a pretty quiet week as far as news events go, I would say you got to leave the trades open. We don't really take any profits. So yeah, great question. Um, yeah, it's really about what makes it for you with this strategy is how big your wins are going to be versus how small your losses are going to be. And you manifest that through consistently holding big trades throughout many weeks. There was one last thing I wanted to say there, and then I'm going to move on to the stacking method. Yeah, that there's technically unlimited potential because there's no take profit. The take profit is a time target. It's Friday afternoon. So when do you close on Friday? I would say usually about 1 to 2 hours before, just basically the same time you would close your overnight trades, 1 to 2 hours before the New York close. If you want to close them, Friday afternoon around lunch, I'm not going to be mad about that. I think that's fine. Um, I'm not so how do I put it, strict on that, because typically if you've had the willpower to hold the trades all the way till Friday, then that's already a fantastic thing. Like you're already pretty good. So I wouldn't worry too much about your timing on Friday. So, but I will say this, I've seen some weeks where the market's been kind of break even for us, and then Friday everything just kind of comes together and we get a huge winning day on Friday. So I mean, yeah, sometimes it's good to hold them the rest of the week. Okay, that's pretty much it on the vanillas trade. So you'd have to go through the process that I just did with you guys for each and every trade, but it is so simple. That's all you have to do is a 2x stop loss, 2x average daily range stop loss, put in your risk per trade, whatever that amount is going to be. Usually you'll just put in whatever I post right here and you're good to go. Okay. I would also suggest that you track your trades, whether that be with a journal or you can just use your order history if you like using your order history. Something that I've enjoyed doing recently is just opening up my FX books. So you can make them private or public, just depends on what you want to do. A My FX book is an easy way to track your trades. And there's a link where you can go to just see how your trades are doing. That's an easy way to track. So, okay, I think that's about it. If I remember that last thing I was going to say here, I'll probably remember it later and I'll bring it up. But let's go ahead and show you how to do the stacking method. Okay, so that's the vanilla way. The stacking method is a little bit more complicated. By the way, I pulled this up for you guys. This is the link to the shared Google Doc, so you guys can have this. And you might want to bookmark this too. This Google Doc teaches you how to take the weekly trades using the stacking method. Couple of things I want to share with you guys real quick on the stacking method. The stacking method is relatively new. We started the stacking method, I think, about a month ago. And basically what this does is it's actually incredible. What it does is, it does a couple of things. The main thing that it does is that if you get a winning week with the weekly trades, is we're going to make those winning weeks more lucrative by scaling into winners. Like we're going to make the winning trades have more of an impact on your trading account, and we're going to make the losing weeks have less of an impact on your trading account. And the way we do this is by, if you get a big old trade that just swings in your favor big time throughout the rest of the week. Let's say you get a trade that goes 400 pips by Friday or 500 pips by Friday. Well, not only do you get one of those orders making 500 pips, but now you've got two other orders that are making, 400, 500, 300 pips a piece as well. And so you magnify that profit by getting even more on that winning trade. And then if you have a week where things don't go the right direction, those trades can typically just fade away on their own. They'll just wither away, typically without triggering you into multiple orders. Now, sometimes you'll have some trades that start to go in your direction by Monday or Tuesday, and then they start to go the wrong way on Wednesday. That's happened to us many times. I've even seen that in the last like several weeks. There's been a few moments like that. And you're going to have some casualties by stacking trades that go the wrong way after they've gone in your favor. The cool thing about it though is even then a lot of those trades have, we use an average daily range stop loss. So even if they go the wrong way, they're only going to lose so much. But if they go the right way, you got trades that can just fly off the shelf and just make so much on the winning side. And there's a few other things that we do as well to kind of stack the odds in our favor. And I'm going to teach you that real quick. But let's go through the process of stacking. I'm going to use an example of this, and I'm going to do one or two examples and answer the questions that you guys have along the way. And again, just as a reminder, this is a newer strategy. So I wouldn't go out there and put like a lot of money into this unless you've done it before. I would suggest that you practice this in a demo account for probably 2 to 3 weeks at least before you pull out the money. And then even then, once you pull out your real money or your prop firm account, I would probably go a little light with that for a little while until you feel really comfortable with it. Because the whole point is I want you to see what it's like, when things go the wrong way, how badly does it get? When things go the right way, how good does it get? Obviously, that's more that side is awesome, but we want you to see what it's like to also see the losing side when you're stacking trades, because you can get into multiple trades that go the wrong way, and it's not fun when that happens. And so you got to see what that's like. Okay, let me go ahead, without further ado, let's jump into how to do this. This is a step by step on how to stack, but let me go through what you're going to do. First of all, this strategy does rely quite a bit on your position size. What I've been doing as a pretty conservative approach, and you can redesign this the way you want, is we're actually using a sequence multiplier on a week-to-week basis. So I've been starting off by risking 0.1% per trade, and that's for each trade. And I'll stack up to 3 total orders in the direction of the signal for the week. If we have a losing week, I'll come back the next week, and instead of risking 0.10, I'll slightly increase the risk to 0.15% risk per trade and also stack those orders. If that week loses, I'll go up to 0.225, or just you could round it to 1.23. You could do that. And we cap it at 0.5% risk per trade total. Okay. So far, this has been absolutely fantastic. This is actually, I'd say, my new favorite way to take the weekly trades, just because it just makes the winning weeks so so profitable that it's like I don't even care for losing weeks anymore, because it's like, wow, I don't care, because when we win, this thing is going to win so much. It's crazy. So let's kind of go through what this is like. Let's pretend this is week 1, and I'm just going to risk 0.10% of my account on this trade. Let's do, let me actually go ahead and delete this order. It's funny. It's actually up like $15 right now, this trade that we took. Go ahead and close it. We're going to redo this order. And I'm going to use the CAD yen as an example. So we know that the CAD yen was a signal for us last week to buy. Let's go ahead and show you how to do the stacking method here. So it's really simple to take the first trade, because the first trade is just an order at market. I wouldn't worry about the units right now. Let's go ahead and put in the stop loss. Now, one thing you should know about the stacking method is we use a tighter stop loss. So we don't give the market 2x average daily range. We actually only give the market 1x average daily range. So one of the reasons for using a tighter stop loss is because there are multiple trades involved on a single currency pair. And so to me, if I get one trade wrong, it's not the end of the world because I have other trades that could potentially trigger later in the week. And I want those ones to also have a tighter stop loss. I don't want to have three different trades that have these massive stop losses. I want them to kind of be very precise in as far as like, okay, if we're going to get in, let's go the right way right away. Or if it doesn't go the right way, let's just cut this trade off, right? So the way this works is, okay, so we got CAD yen strong buy. Also remember the average daily range is 76 pips. Well, that's easy because I'm just going to use 1x average daily range for my stop loss. So 76 pips is what I'm going to put in. Okay. For my risk, I'm just going to follow what's in the little journal that I gave you guys here, this little Google Doc. So 0.1% is what I'm going to use as my risk for week one. Okay, so 0.1. Okay, so I'm risking $112 on this trade. If the trade loses, I would lose that much. If it wins, it could technically win an infinite amount because, again, we're not using a take profit. No take profits allowed. Seriously, don't even think about it. Like you might be thinking, oh, I'll just put in like 100 pip. No, don't even don't do that. Let your trades run. Again, some of these trades really do run hundreds and hundreds of pips by the end of the week. And we got to get those things out there. Oh, that's actually what I was going to say earlier on the vanilla. So, yeah, I mean, I get some people, I've seen some people say, and these are usually scalpers that are like, 76 pips stop loss, that's huge. Well, yeah, that's huge if you're scalping, but that's very normal. And that's a very accurate signal for, or accurate stop loss, average daily range. I think for the CAD yen, that's a very appropriate stop loss for something that you're trying to hold all week. You got to give the market more room if it's a bigger trade that's meant to be held for 5 days, right? So you can't get away with a 10 pip stop loss. You can't get away with a 20. You know, you have to give the market sufficient space to be able to navigate what it needs to navigate, right? So that's the reason for that. And again, you're not going to ever win 800 pips on a trade or 500 pips on a trade with a 10 pip stop loss. You win 800 pips on a trade, 400, 500 pips on a trade because you have 100 pip stop losses, right? Like that's how you get there. or 50 to 150 pip stop losses or thereabouts, right? So that's why we do stop losses like this for the week, okay? Also, another good recommendation is use an hourly time frame. That's probably the best time frame to look at a weekly. Like the hourly candlesticks probably give you good view of what you're actually looking at. If you try to take this trade like on a daily chart or a weekly or a monthly time frame, you're not going to be able to see what you're looking at. Okay, so let me go ahead and take this. So this trade's ready to go. This is trade number one. So this is my market order entry. Let's say I'm taking this on Sunday night or right when I take the weekly trades, I'm ready to go. And I'm just going to hold this trade for the rest of the week. Okay. Now I'm not done yet. This is what I basically would do if I was taking the vanilla strategy. If this trade really starts to take off in my favor, I want to stack into this order. That's why it's called the stacking method. The way you stack into this trade is you go up a half an average daily range. Okay, so a half an average daily range on the CAD yen is what again? You can find this right here on the scanner or on the Telegram that I sent you guys. So it says 76 pips. So half of that is going to be what? That's going to be like 38. Am I doing my math correctly? 38. Yeah, 30. Okay, 38. Yeah, perfect. Nice. So half of that is 38. So half an average daily range apart is what we're going to do to space these trades. So I'm going to go up from the current price of the market, so about here where we got into the trade, and go up about 38 pips. So like right there. It doesn't need to be exact. It can be close enough. Like I think I have it at 40. That's close enough. I'm going to draw a little line right there. And then I know that that's where one of my trades is going to go. While I'm still here, let's go ahead and measure the third trade because I take a total of 3 trades total. Let's go up another 38 pips or so, like right there. And let's go ahead and add another horizontal line. Okay. So now I've plotted out where my other 2 trades are going to go. This is super easy. Watch this. I'm going to hit buy again. Okay. It's going to remember all the credentials from my last trade. I'm still going to use a 76 pip stop loss. Still. All right. My risk is still 0.1. That's the total risk on each trade for the entire week on every single signal is 0.1% risk. Okay. The difference, though, and I actually should have led with this is not a stop order, or excuse me, this is not a market limit order. This is a stop order this time. So we're not buying at the current price. We're going to buy if the market keeps going in our favor. Okay. We're going to add into the trade if it goes in our direction. This is something that, statistically speaking, most retail traders will not add to their winners. I'll share another statistic with you. 80% of winning traders add to their winning trades consistently. There's a lot of studies that can back this up, and it's actually the most unifying statistic or metric across winning traders. So if you're statistically a winner in the markets, which is hard to do, as you guys know, if you want to become a winner, the best thing that you could do to become a winner is to add to your winning trades. Like that is statistically the number one thing you could do. That and also avoiding the things that losing traders do, which is like not using a stop loss. So if you're using a stop loss, boom, that's going to help you already. And if you're using one that's appropriate for the trade that you're about to take, that's going to help you. Okay. What else can you do to set yourself aside from the losing trader? You don't add to losing trades. You only add to trades as they go in your favor. That's going to set you apart from losers as well. So don't add to losers. Always use an appropriate stop loss for the context of the trade that you're taking, and always add to winning trades. Or most of the time you should add to winning trades. Those are like the 3 things that you can do to completely set yourself apart from the losers and put you justly right in the winning bracket of winning traders. Okay, so let's finish this trade off, and then we got to take the second order here. So this buy stop order, we got to put in the price, which I've already drawn that for you right here. It's 107.407. 107.407. Okay, the trade's actually ready to go, but let's just review what we did. So we slid this over to stop order because this is a buy stop, not a market order. The units are still where they were on the last trade, which is 0.10% risk. I've got a 76 pip stop loss, which is exactly an average daily range for the CAD yen. And I'm just going to go ahead and click buy. And once I click buy, what happens now is I've got a second order on my screen. So I've got this original market order and its stop loss is down here and it's $112 of risk. I've got another buy order ready to go that will trigger if the market starts to go in our favor. We're going to add into that if the market starts to go in our direction. And we got a stop loss down here that's 76 pips away down here. Okay. And now we want to do one final order. I'll stack into a total of 3 trades if things go in our direction. So I'm going to hit buy again. Let's slide this over to stop. Let's change the price to this upper buy price, which is 107.807. Oh, that's not, I'm messing that up. Sorry. 107. Oh, it's because there we go. 107.807. There we go. Okay. Don't use a take profit. We got to use a stop loss and it's ready to go. So I'm going to go ahead and click buy. Boom. And that trade is now ready for the whole week. This is the stacked method for this entire trade. I literally don't need to do anything else on this trade the rest of the week. I've got my market order in. I've got my 2 stop orders in ready to go. And the market can go as high as it wants to go. I've got no take profit. Sky's the limit. If this thing just takes off like this, we'll be talking about this trade. All right. Like this will be fun because you'll be making a lot of money. Now, the market can do a couple of other things too. We hope if it loses that it just loses right away and goes down like that, because you'll just lose on one order. You'll lose on one trade, which is not fun, but it is required. If the market goes the wrong way, we want to make sure that we lose appropriately and that it's an amount that we allocated and all that kind of good stuff. That's all right. And this market can just lose one sided. On occasion, and I wouldn't say it's just occasional, like this does happen often. So, but it's not like the norm, like all the time. But you're going to have sometimes where the market triggers all three. And then by like a Wednesday or Thursday decides to just cut back. Okay. That does happen sometimes. And you are going to lose more on that type of a trade. And it's going to stink because you're going to trigger into all three. That means that all three were profitable at some point, and then all three of them turned against you. Okay. There's really nothing you can do about that. It's just unfortunate, and you are going to lose a good stack of money on those trades. But let me tell you this, you are going to if you keep doing this over and over and over again, you're going to have some winners that take off like this that absolutely cover any losses, that any stupid stuff that happens in the market during the week that cuts you out a few times during the course of a month or something. You're going to have some trades that just look like this, where who cares that you stopped out of three other trades 2 weeks ago. But it stinks in the moment, because if that's what happens and you feel the sting of that, that's not fun. And you're going to lose, let's see, 0.1 times 3, so 0.3% of your account, a third of 1%, if all three of those were to lose. And it does happen sometimes. And just get ready for it and let it happen. Just brush it off. Don't let it affect your day. If that happens, it's going to happen at some point. But again, you're going to have, a handful of trades during a month that just fly off the shelf. And those are the trades that are going to pay you big time. One last thing that we need to cover, and any questions up to this point. So the reason for this is so that we can separate ourselves from losing traders. We're doing the hard thing, which is add to winners. No one wants to do that because everyone wants to take profits. If you got a good thing going, we got to let the good thing just keep on going. Okay. I've even had a few of these. Like one time I had a trade that took off, all three of these took off, and then one of these trades closed out, like right there at the stop loss. And then it continued the rest of the week in our favor. So I did lose on one of them, but then the other two just kept making money by the end of the week. So there can be like a couple of different variations of how the trade can play out, but you don't need to do anything. That's the beauty of it. Once this model is set up, like I've just shown you here on all of the signals, you literally don't need to do anything else. Just let them do their thing, come back Friday, take your profits on the winners, count your losers, and come back the next week and do it again. With that in mind, the last thing I need to cover real quick is the sequence multiplier. If you have a losing week, one of the things that I've been doing with the stacking method is the next week I'll come back and I'll risk slightly more per trade while still doing the stacking method. So it's a form of like anti-martingale and martingale at the same time. You're basically increasing the amount that you could make on the winning trades if the market does go in your favor big time because of that stacking side. And then you've got the slight hint of martingale where you're increasing on a week-to-week basis on each trade if the previous week ended in a loss. And what this does is when you hit a week where everything just flies off the shelf, you get the benefit of the stack to increase those profits, but then you also get the benefit of the slight hint of martingale that increases the substance behind those trades. So I hope that makes sense, but it will over time. If it doesn't make sense yet, just you wait, it'll make sense, and it's really, really fun. So all right, guys, that's about it. I got to run, but I appreciate you guys hanging out with me. And I think, we went right to the top of the hour. This is recorded. This will be on the website. So if you guys need to come back and watch and review this, feel free to do that. But let's have a great week, guys. I'll be taking my weekly trades tonight after the COT data comes out sometime around 8 p.m. Eastern time. All right, guys, have a fantastic rest of your day, and we'll see you guys in the next webinar.